Today we're going to talk about share-based compensation. This is when companies try to incentivize employees by giving them an opportunity to either receive stock shares after a certain time period. So they're trying to lock in the employees for usually a few years, anywhere from as little as 2 to 5 years. And they call that the restricted period or the lockdown or the lockup period, whatever you want to call it. But they value these employees and their contributions, and by offering them these incentives, hopefully that increases productivity and buy-in, and the people feel invested in the company. So they either get shares granted to them or they get the opportunity to buy them at an advantageous price. So we're going to look at stock awards, both restricted stock awards and restricted stock units. By and large, they're accounted for the same way. I'll talk about the difference in a little bit, but the accounting is identical. Stock options, which we'll talk about, and then employee share purchase plans. Now, the main objective for all of these is to make sure that we use fair value when we're calculating the cost of compensation, and we have to spread the compensation expense over the proper time period using the matching principle, one of the founding concepts of accrual basis accounting. Okay? So when we talk about restricted stock plans, like stock awards and stock units, okay, we use fair value at the grant date. Now the grant date is the day that this incentive starts. That begins the lockdown period, which is usually from 2 to 5 years. They can't touch these shares until that time period is ended. And if they are terminated, they quit, something happens, or they don't achieve certain performance objectives, then they can forfeit these shares. Okay? So a restricted stock award is granted, the shares are granted on the actual grant date in the names of the employees, but the employees can't access them until the lockup period ends. Okay? Whereas a restricted stock unit, let's take a look at the definition here, are not actual shares but rights to the shares or the equivalent value in cash after the vesting period has ended. The vesting period is that locking period. Once the shares have vested, the employee is free to access the shares and if they want to sell the shares. Okay? So notice it says the restricted stock units are more desirable from a company standpoint because what it does is it delays issuing the shares till the end of the period when they've earned them. And notice what it says, it delays the dilution of earnings per share. Okay, so when you issue additional shares, there's more shares outstanding. And if you recall the equation for earnings per share, you have net income and you divide that by the number of shares outstanding. The more shares in the denominator, the lower earnings per share. So that's called diluting earnings per share. We'll be talking about earnings per share in another video. Okay? And also with restricted stock units, the employee may decide they want the cash equivalent, which will not dilute the earnings per share because you will not be issuing additional shares. So for that standpoint, restricted stock units are more popular than the stock awards. However, the accounting for them is identical. Let's take a look at this example. On January 1st of 17, the company, grants 2 million shares of common stock at a $2 par value to the employees, and they vest in 3 years. So that's the lockup period. At the grant date, the day of the inception of this program, the market price of the stock is $30 per share. That's what it's trading at out there, assuming it's actively traded. So notice on the grant date, the beginning of this program, there's no journal entry. We recognize the expense at the end of each period, in this case, the end of each of the 3 years. So the total compensation expense, very simple, 2 million shares granted at a market price of $30 per share on the grant date, not the exercise date down the road, okay? That's $60 million. We divide 60 million by 3 years, that's 20 million per year. And at the end of each of the 3 years, it's a very straightforward journal entry. Debit compensation expense, credit paid in capital restricted stock for $20 million. Now, at the end of the 3 years, assuming all the shares are granted, then what we're going to do is we're going to debit the paid-in capital restricted stock, and we're going to credit common stock for 4 million. How did I get that? 2 million shares times the $2 par value, and then we credit additional paid-in capital for common stock for the balance, which is 56 million in this case. Okay, and as we mentioned, the employee may elect the equivalent value in cash. And if they do so, then the company has to recognize a liability when they're recognizing the compensation expense. And so you can see the journal entries are very similar. Instead of crediting PIC or paid-in capital, you credit the compensation liability each year, and then at the end of the 3rd year, you debit the liability and you credit cash. Very straightforward stuff. Okay? Any forfeitures that occur, you would simply reverse the journal entry for the amount forfeited. Okay, stock option plans are a little bit trickier, but they're not bad. There's just one little twist that I will point out, and once you grab that, then these aren't bad at all. Okay, so a stock option allows the employee to purchase stock at a locked-in price. So they're not giving them shares like a restricted stock unit or a stock award plan, but they're granting them shares at an advantageous price, hopefully an advantageous price. Anything can happen out there. Okay? Notice the same restrictions and vesting periods exist with ESOP, is employee stock option plans as well. Okay? So it goes from the time periods from the grant date to the vesting date when they release the shares. Okay, so notice what it says here. To determine the fair value of a stock option. Okay, these are what's called derivative securities. They derive their value from the stock that it relates to. Okay, we have to use a stock option pricing model, and one of the more popular models is called the Black-Scholes option pricing model. You don't need to remember that name. The price of the option will be given to you. That's more of a finance issue than an accounting issue. Okay, now stock options expire after a certain time period, and so there's an active market for stock options, and their price can fluctuate as well. So there's a market, there's the commodities market out there for stock options. Okay, so we're going to use the market price of the stock option to measure compensation expense, not the stock price. That's the catch right there. Okay, we'll use similar numbers here. I think the number of shares are slightly different, but 3 million shares of stock options are awarded, $2 par value stock, and they vest in 3 years. And on the grant date, the market price of the stock was $30 per share, and the market price of the stock option, which is what we're going to use, is $5 per option. So notice the total compensation expense will be the 3 million shares times the $5 market price of the option, again, not the stock price. And so total compensation expense will be 15 million. And the journal entry at each of the 3 years will be compensation expense, 5 million. We take 15 million, divide it by 3 years. So debit compensation expense, 5 million. Credit paid in capital stock options, 5 million. Very straightforward. Companies should try to estimate if they believe there will be some forfeiture. Okay, that means not everyone's going to get to the end of the vesting period. Some people may quit voluntarily, some may be terminated. If this is performance-based, some people may not achieve those performance objectives. Okay, so if they can estimate an amount, they should. Okay, they can also do actual forfeiture as well, but let's take a look at this example. So same data, but we estimate a 10% forfeit rate. So 100% minus 10% gives us 90% of that 15 million would be our compensation expense. So 15 million times 90% is 13.5 million over 3 years. So we divide it by 3 years, and that'll be 4.5 million per year as the new compensation expense. This amount would be the journal entry at the end of each year. Now, in the event that the estimate is made in the middle of the lockdown period, say for at the end of the first year, they estimate 10%. Well, they recorded 5 million in the first year, but now the new estimate says it should be 4.5 million. So if you think about this, if we, at the end of year one, we say, you know what, we think 10% is going to be forfeited. In year one, we recorded 15 million divided by 3, that was 5 million in compensation expense. But now we estimate that 10% is forfeited, so the total compensation expense should be 13.5 million, which would be 4.5 million each year. So at the end of year two, and you have to think this through, at the end of year two, had we recorded 4.5 in year one and 4.5 in year two, we would have 9 million, right? So at the year two, we're going to record 4 million as compensation expense. The journal, the debits and credits stay the same. Okay, because at the end of year two, we want to have 9 million, which is 2 years times 4.5, recorded as expense, and then in year three, we would record the 4.5 million of compensation expense. Okay, so you got to think that through. It's not that bad. But again, if the estimation comes in midstream, then we have to adjust our calculations a little bit to account for that. In the first example, we estimated from the beginning. And so we simply took 15 million times 90% is 13.5, divided by 3 years, and we had 4.5, 4.5, 4.5. Okay? But again, if at the end of year one, we say, you know what, now we think 10% will be forfeited, we've already recorded 5 million in year one. Had we known about the 10%, it would have been 4.5 in year one, right? And then 4.5 plus 4.5, at the end of year two, we would have had 9 million. So that's where the 4 million comes. 5 plus what number this has to be, so that 2 years of compensation expense would be 9 million. Okay, in this case, it would be 4 million. And in the last year, we can record the 4.5, and what we want is for the 3 years, the total compensation to equal 13.5 million. Okay, so hopefully that makes sense to you. I'm going to clean the board here. Okay, so I would say stock options is probably the trickiest of the share-based compensation plans. Okay, now going back to the original example, excluding forfeitures, at the end of the lockdown period, the shares have vested, and if all the options are exercised, then 3 million shares will be purchased by the employees at a $30 price at the grant date. Now, we hope and assume that the market price is higher than 30 bucks. If you think about it, if the market price in that time period went up to 50, then they just made $20 per share profit on 3 million shares. Of course, each individual person has a smaller number of shares, but that's a nice gain. Okay, so we don't know what the market price is. We're assuming it's higher than the exercise price. If it wasn't higher than the exercise price, why on earth would they exercise these shares? They would just buy them on the open market. Okay, we'll talk about that in a second. Okay, so they purchase the shares, 30 bucks each, 3 million. The firm collects $90 million, debit cash. And again, they're issuing these shares, so they're going to debit paid-in capital stock options for 15 million. Remember, each year we had credited 5 million to that account, so now we're going to debit it to clear it out. And now we're issuing the stocks. It has a $2 par value, so 3 million times $2 per share is 6 million. And of course, the balancing entry is to additional paid-in capital for 99 million. Okay? Notice it says the current market price of the stock doesn't affect the journal entry. Okay? And again, those gains that the employees will receive, and they can be hefty, are taxable. So tax planning is necessary for people who are about to go cha-ching. Okay, and as I mentioned earlier, when the market price is below what they call the strike price or the exercise price, the options are underwater, and no one in their right mind is going to lose money by exercising these shares. unless there's some weird tax angle they're working. Okay? If that's the case, notice the options would expire since they all have a time limit on them, and we would reclassify the account paid in capital stock options to paid in capital expired stock options. Okay, so that's kind of a weird account. And so you have to go back to the original journal entries. Each year, we recorded a debit to compensation expense, credit to paid in capital stock options. Now think back, any expense, including compensation expense, gets closed out to retained earnings. So in essence, we debited retained earnings, we reduced retained earnings, and we transferred it into the paid in capital account. There was no cash involved, other than when they exercised them, okay? So those journal entries didn't affect assets or liabilities. It was a rearrangement of the stockholders' equity accounts. So we had already debited retained earnings, which means we had put it into the paid in capital section. And so now this reclassification is within paid in capital. Has no impact financially on the company whatsoever. Last, we have employee share purchase plans, where people can buy shares directly from the company. And these are fairly common. I think Starbucks has a plan for their employees. And the concept is, the more stock employees own, the more they feel like they're part of the company and that the company's success means they're successful. And that's true. When stock price goes up, they make money. So it hopefully enhances the loyalty of the employees, improves performance, that what they call esprit de corps, just the spirit of the company. They're good plans for the most part. So in order for a stock purchase plan to be considered non-compensatory, in other words, it is not recorded as an expense, it has to meet these 3 criteria. All employees are able to participate. It's not just for the executives. Employees have 1 month to participate once the stock exercise or strike price has been set, and the discount cannot exceed 5%. If the discount exceeds 5%, then the amount of the discount is the compensation expense. So let's take a look at an easy example to illustrate this. Okay, an employee can purchase common stock has the $5 par value at a 10% discount. If the market price is $100 and they can purchase it for $90, that's the 10% discount, and they buy 1,000 shares, then the company is going to receive $90,000. That's 1,000 shares times 90. Okay? And the 10% discount, 1,000 shares times 10 is $10,000. That's compensation expense. So we debit compensation expense. We credit common stock, 1,000 shares times the $5 par value, and APIC gets the remainder, which is $95,000. Very straightforward. And that's share-based compensation.